Good afternoon, and welcome to the SEC's 44th Annual Small Business Forum. I'm Stacey Bowers, Director of the SEC's Small Business Advocacy Office, and we are thrilled to welcome you to this important event and to be doing so in person here at the SEC's headquarters. I want to extend a warm welcome to all of our attendees and exhibitors for joining us this afternoon, whether here in the auditorium or online. The forum provides a venue for small businesses, entrepreneurs, small public companies, and their investors to come together and collaborate as a team on ideas to improve small business capital formation. If you haven't noticed already from the agenda titles, knowing that the forum would be just days after the NCAA March Madness Finals, we have had fun with this year's theme of sports and teamwork. And while this auditorium can't hold those kinds of crowds, the forum does create an opportunity for the small business community to come together with the commissioners, commission staff, other government agencies, and thought leaders as loyal fans. Before I say more, on behalf of myself, the commissioners, and my colleagues here at the SEC, I want to state that the views expressed today are each speaker's own, in my case, in my capacity as the director of the Small Business Advocacy Office, and do not necessarily reflect those of the Commission, any of the commissioners, or any of our colleagues on the staff. We all know the importance of small businesses to the economy and country, but were you aware that small businesses created 80% of net new jobs since 2011? Many of these businesses need support from others to build and grow their companies. You may know that entrepreneurial support organizations like incubators and accelerators play a key role in supporting and mentoring early-stage companies. But did you know that entrepreneurs who work with those organizations are likely to raise more capital and generate more revenue? Later-stage companies are also finding support. More than 62% of VCs engage with their portfolio companies at least one time a week. However, 77% of small businesses are concerned about accessing the capital they need. And while VC ecosystems are growing across the country outside of traditional hubs, many areas do not have a strong community to support small businesses. Turning to the public markets, IPOs ticked up in the first half of 2024, 101 as compared to 83 in the first half of 2023. But they were still well below the 2021 peak. Looking specifically at smaller company IPOs, they accounted for 40% of the number of IPOs since 2022, but only 4% of deal value. So we continue to see challenges across small business life cycles. The SEC's Small Business Forum is designed to bring together a wide range of voices from both the public and private sectors so we can huddle up to discuss different ideas and perspectives and to strategize about ways to support small businesses raising capital from investors. During our time together today, we will have the opportunity to hear insights from our commissioners, as well as the voices and stories of our speakers, founders, investors, industry specialists, small public company executives, and lawyers. Equally as important is hearing from all of you who took time out of your busy schedule to attend. The shared experiences for participants in the small business community often provide the impetus to reevaluate our playbook and consider ideas in different ways or from different points of view. A key purpose of the forum is to provide a pathway for the public to shape policy recommendations to improve capital formation for small businesses and their investors to the Commission and Congress. Many of you have already provided policy recommendations, and for that I thank you. If you have recommendations that you have not yet shared, there is still time to do so by emailing them to us at smallbusiness@sec.gov before 3:30 p.m., the end of our second panel discussion. You can also view recommendations received on the voting portal. And after our last panel this afternoon, we will invite participants here in the auditorium who would like to share brief thoughts on any of the recommendations to step up to the microphones. We ask you to limit your comments to about 1 minute to allow as many to speak as possible. After that, all participants, whether here in person or online, will be able to vote through the portal to prioritize the recommendations. We do ask that you hold off on voting until the end of today's events to ensure you are weighing in on the final recommendations, including any late-breaking additions. Recognizing that companies and investors have different needs at various points in their life cycle, we group the recommendations into 3 cycle categories: early stage, growth stage, which includes smaller funds, and small cap and public companies. We will include the top 5 recommendations from each life cycle section in the SEC's report to Congress on today's Small Business Forum. You can find the portal and information about the recommendation topics under each life cycle on the SEC.gov event page, or if you are here in the auditorium, there are signs posted out in the atrium and handouts by the door. With those logistics out of the way, I just want to say that it's hard to believe I am well into my 2nd year as the director of the Small Business Advocacy Office. I continue to be amazed at what I learn from our stakeholders and others who play a role in the vital small business ecosystem. I'm excited to hear more from our speakers today, as that information assists all of us at the SEC in understanding how we can continue to support capital formation for small businesses. I know I say something along these lines at almost every event where I have the privilege of speaking, but the Small Business Advocacy Office is made up of an incredible team of individuals whose passion and dedication in supporting small businesses and their investors on the capital raising journey is unwavering. I want to thank each and every one of them for their commitment to this event, the office, and in leading the charge to be a voice for small businesses everywhere. Now I'd like to welcome Acting Chairman Ueda to the stage to share his thoughts with us, followed by Commissioners Peirce and Crenshaw.
Well, thank you very much, Stacy, and good afternoon, everyone. It's my pleasure to welcome you to the SEC and to this year's Small Business Forum, which is the first forum that's been held in this building since 2016 and the first in-person forum since 2019. I hope that everyone takes advantage of the in-person interactions and networking opportunities this afternoon. This year's forum groups various issues affecting small business capital formation into 3 categories, which are reflected in the 3 main panels: early stage capital raising, growth stage companies, and small cap companies and the public markets. This grouping of topics highlights the importance of the securities laws at every stage of a company's life cycle. By enabling companies to raise capital through cost-effective regulations without sacrificing investor protection, the Commission has an important role in fostering innovation, creating jobs, and generating economic growth. Starting with early stage capital raising, the Commission should design regulations that enable entrepreneurs to raise capital without disproportionate compliance costs, especially in the form of legal fees. These costs usually arise from unnecessarily complex rules. When the question is asked, what's the offering exemption for the friends and family round? The answer should not be, it depends, followed by a discussion of at least 7 factors that require a chart to digest. While cost-effective regulations are always important, they are especially critical for early-stage capital raising by startup companies, whose cash flow and resources are often scarce. $1 extra spent on legal fees is $1 fewer available for developing innovative products or services. Accordingly, the Commission's regulatory regime on this topic should be especially considerate of how offering exemptions will be practically used. Turning to growth stage companies and smaller funds, one of the key issues is how to provide retail investors access to these private companies. Such higher risk but higher reward investments can help complete a diversified portfolio. Discussions of expanding retail access to private companies usually revolve around the accredited investor definition. It's been more than 40 years since the Commission adopted the definition and established income and wealth as common ways for individuals to qualify as accredited investors. Consideration should be given as to whether additional ways to qualify as an accredited investor and whether they are appropriate. Alternatively, is the all-or-nothing approach of the definition the appropriate way to regulate investor participation? Or should every individual be permitted to at least invest a small amount every year in private companies? These issues are worthy of further discussion and consideration. Finally, for companies that have accessed the public markets, the Commission should ensure that their ongoing reporting obligations are proportionate to their size and resources. under the Commission's current rules, a company with a $250 million public float is subject to the exact same disclosure requirements as a company with a $250 billion public float. The Commission has not updated its thresholds for how companies qualify as an accelerated filer or a large accelerated filer since those thresholds were first established in 2005, nearly 20 years ago. While the Commission has made changes as recently as 2020 to its smaller reporting company definition, the different filer categories are now complex and sometimes overlap. The result is that some smaller reporting companies must provide an auditor's attestation of the company's evaluation of its internal controls or financial reporting, while others do not. A more harmonized regulatory regime for who qualifies as a large, mid-size, and small company, together with scaled disclosure requirements, can help ensure that the Commission's rules are tailored to a company's size and resources while still maintaining appropriate levels of investor protection. I look forward to receiving a readout of the discussions of each of the panels and reviewing the policy recommendations. There's something that, as somebody who has worked on assignment over in the halls of Congress, I can tell you members of Congress closely read this report every year and its recommendations. So thank you, Stacy, and her entire team in the Office of the Advocate for Small Business Capital Formation, as well as the many other members of our staff, including in the Office of Support Operations, for planning this event. And enjoy the forum.
Good afternoon, everyone. I want to echo the chairman's thanks to Stacy and the rest of the staff who put this event together, and thank you to all the panelists for being here today. I think it'll be an excellent discussion. This is a wonderful opportunity to bring together the perspectives of a broad range of market participants. Last night, the Senate confirmed Paul Atkins to be our next chairman. I'm looking forward to his return. He is smart, experienced, and keenly attuned to the Commission's mission, including its objective of facilitating capital formation. In his last stint here, he was a commissioner from 2002 to 2008. And I think he's going to find that much has changed here, but some things will be very familiar to him still. The agency still has a lot of work to do on making it easier for small companies to find funding and to meet their regulatory burdens. In fact, looking back at a statement from then Commissioner Atkins, he gave this to a small business forum 20 years ago. He was talking about the burdens of Sarbanes-Oxley 404. And as we heard at last year's forum, that issue is still live, and Commissioner Atkins will be able to pick up right where he left off. Recently, I was out in the park and I came across a strange scene. It was a fireman actually rescuing a cat from a tree. Now, I thought that was always the kind of thing that people talked about but never actually happened, but I witnessed it. And so I hope that this year's forum can help us turn the talk for reform into something that we can have that's just as real as that cat in the tree. I do have a number of questions. First, we have a lot of tools in place for private companies to raise money to help take their businesses from one stage of growth to the next. But I do wonder whether these tools are currently being used to their fullest extent. Market participants often tell me that fitting into our exemptive framework is sometimes no small task. What are the biggest hurdles to using our existing rules? Regulation crowdfunding is something that I think a lot of us really hope can be something very valuable, and it is for some companies, but is it a feasible path to raising funds for many companies? I'd like it to be. I've heard that from issuers that the costs are prohibitive, and from funding portals that the margins are very slim. I've also heard that an issuer that has done a reg crowdfunding offering may be less likely to receive subsequent investment from more established institutional investors. What changes can the Commission make to improve the usability and lower the costs of using reg crowdfunding? Reg A is also getting some fresh attention, in part because of consideration of how it might apply in the crypto context. And so as we're considering whether Reg A might have potential in that context, what other changes could the Commission make to increase its use in other contexts more broadly? Last year, one of the forum recommendations advocated for the expansion of the accredited investor definition. I'm not a big fan. I would rather eliminate that definition altogether and the distinctions that go with it. But what additional measures of sophistication, if we're going to keep that distinction and that definition, would be appropriate for someone to be deemed to be an accredited investor? And then finally, is the current test for determining filer status as practical as it could be? Chairman Ueda mentioned this. What modifications could the Commission make to simplify that process? Thank you so much, and I hope that you enjoy the rest of your afternoon. And I look forward to watching it and later and hearing your recommendations as well. Thank you.
Good afternoon, and thank you to Stacy and team. Really appreciate all the work that goes on to these events, and thank all of you for being here. It's hard to imagine a more important week to focus on small businesses. It has never been easy to be a small business owner. But after the whipsawing market events of last week, you could perhaps say that there are a few times in recent memory when it's been more stressful to be a small business. Even with a reprieve, uncertainty, and unpredictability, these are all generally bad for business. So given current circumstances, it's more important than ever that the Commission is mindful of our mission's directive to facilitate capital formation, particularly for small business owners who usually bear the brunt of adverse market developments. Small businesses already wobbled more due to recent market volatility than their larger counterparts. Over the course of last week, the Russell 2000 index, composed of smaller companies, weathered greater losses than other major indices with larger company constituents. I firmly believe that facilitating capital formation and protecting investors are not mutually exclusive mandates. Instead, they are co-equal directives between which we should seek careful equilibrium. Markets, including those that support small business growth, function better when investors can participate appropriately, safely, and with confidence. So, today I'm here to ask, how can we provide your businesses with greater exposure to investors who are the right match to contribute to your growth and success? How do we balance facilitating capital formation and maintaining meaningful protections designed to ensure that investors can access products that are appropriate for their financial goals? Today's agenda will cover an array of issues and regulations that exemplify that balancing act. As you know, many of these topics are already top of mind for the staff and the Commission. But your input is crucial to arriving at policy outcomes that create real opportunities for small business growth and investment. On the topic of early-stage capital raising, the accredited investor standard is a perennial topic of debate. I'm sure Chairman Atkins will find that as well as 404. While many agree that the standard needs to be revisited, there is less agreement in how that definition should be updated. For example, last spring, the Commission's Small Business Capital Formation Advisory Committee discussed the issue of revising the accredited definition and made recommendations including adding a qualifying educational program while preserving the current financial thresholds. Meanwhile, I have expressed concern with the Commission's failure to index the thresholds to account for inflation. I worry that leaving the accredited investor standard in its outdated form provides a de facto and significant expansion in access to private markets. These investors do not reflect the original intent of the standard, to exclude only those investors who can fend for themselves. We should not passively scope investors out of the protections of the Securities Act purely due to the passage of time and related macroeconomic changes. Is there a way, then, for us to revise the accredited investor definition for today's world that finds a middle ground between providing access to capital and appropriate investor protection. The decision of whether to pursue becoming a public company is another topic where your experience and input is deeply valuable. Why do companies increasingly choose to stay private? Recent research suggests that the oft-heard explanation of overburdensome regulation and related costs may not necessarily be to blame. In fact, it's widely known that the U.S. IPO market has declined for decades, but most commentators ignore that this smaller population of public companies account for a share of the U.S. GDP that is roughly double that same figure in the 1990s. While it's true that fewer companies go public, the ones that have done so are faring better than ever, despite the regulatory regime. So, how do small businesses actually think about the IPO process? Is there more to the story? Finally, I'd like to leave you with some food for thought on retail access to private funds. This topic has consumed much attention in recent months, and we have started to see ideas for how to remove barriers to private funds for retail investors. Some of those involve exposure through register funds in various ways. As the public and private markets have roiled and churned in recent days, I am reminded of why some of the restrictions on retail access to these vehicles exist in the first place. How would increased retail exposure to private funds impact investors in times of market stress? How would retail investors fare alongside more sophisticated investors in such vehicles? As small business owners, you are on the front lines experiencing many of the ebbs and flows of our markets and overall economy. From this vantage point, you are uniquely able to help us find the balance between facilitating capital formation and our mandate to protect investors. Thank you for your participating in today's forum. I know your input will make the staff and the Commission more informed and more prepared to face the challenges of this week and tomorrow. Thank you.
I want to thank Acting Chairman Ueda, Commissioner Peirce, and Commissioner Crenshaw for joining us this afternoon to kick off this year's SEC Small Business Forum and sharing their insights. Next up, we have Jenny Riegel from our office with our first one-on-one, Finding Home Field Advantage Outside Traditional Hubs. Jenny, thanks for getting us going today.
Thank you, Stacy. So as Stacy mentioned, I'm Jenny Riegel, and I am here with the Office of the Advocate for Small Business Capital Formation. I'm thrilled to kick off this year's forum with Andrew Prestai, who is the CEO and co-founder of Event Vesta. Andrew, this is not your first forum, I understand. You joined us back in 2019 when we were in Omaha, Nebraska. So I am thrilled to welcome you back. I would love if you could kick us off by telling a little bit about yourself and your entrepreneurial journey.
Yeah, thanks for having me. Also, the very full circle moment of that was when I was first getting started with Event Vesta back at that 2019 forum. So to be here multiple years down the line, especially as everyone can tell by the name, getting started in 2019 in the events industry, not exactly the best market timing there. So don't ask me for my stock tips, my fantasy football picks, who I picked in the March Madness bracket. I think you can all figure I'm not the best at the timing there. But I was born and raised in Omaha, Nebraska, was lucky enough to go to Creighton for my undergrad and my MBA, but I always knew that I wanted to be an entrepreneur. That my mom was a serial entrepreneur, had many, many businesses, probably too many for her own good, and so I saw the good and the bad of having your own company. But at Creighton, I found my calling in tech startups. And when I was graduating, I joined up with one of the MBA professors to start our first company called DriveSpotter, which was a computer vision startup helping commercial trucking fleets with their safety and efficiency back in 2016. So that was kind of like the crypto or AI of its day, a very heady technology, a lot of interest in that market. So we were able to go through an accelerator program focused on insurance in Des Moines, Iowa, and then a TechStars program in Detroit focused on mobility in 2016, shortly after that, and raised around $1 million in venture funding. Unfortunately, that company didn't quite go the way that we all wanted it to, and so after I left that, I still had the bug. I wanted to start something else, and the opportunity I kept seeing was events. I was part of the Omaha Chamber's Young Professionals Council. I was on the chamber board and saw that it was so hard to get the awareness of the events that we were hosting, of the awareness of the chamber events, and also our partners in the community, not because there wasn't enough channels or enough places for people to go and look, but because there's too many different ways that event organizers need to promote their events. And so we built a platform that could help them acting as like a ZipRecruiter for local event promotion for now hundreds of businesses in every single state across the country, working with everyone from the Capital One Arena to the Boston Symphony to Dave & Buster's, and more importantly, for me at least, a lot of small businesses and nonprofits across the country, giving them another cost-effective channel aside from just putting more money into Facebook ads or Google ads to try to get the attendees that their events deserve.
Excellent, thank you. And it's cool to hear how entrepreneurship and your family has that's been your North Star in guiding along the way. I know one thing that we often hear from entrepreneurs is support, and that you can't just grow a company alone, and how supports need to come in different ways. One common support is an entrepreneurial support organization, ESO, also known as an accelerator or incubator. Another support that I know is part of your journey has been the small business programs that have been fueled by the state of Nebraska. So I'd love for you to talk about kind of how those support systems came together to help kind of grow and have your business be where it is today.
Yeah, no, happy to, because without those programs, wouldn't be here either with the first company or with Event Vesta. Forgot to mention this in the intro, but also was lucky enough to go through a Techstars program with our current company as well, with the Minnesota Twins. So 2 times Techstars founder. So very much have seen the benefit of the accelerators, and talking with the wonderful MD that we had for the Twins program, joke that you go to Techstars to learn how to run a business, not just to learn how to raise money. And I think that's very much the case for a lot of other ESOs across the country, where they help you with what is a venture capital, what's the accredited investor standard, what's an 83B, what's a 409A, what are all of these things that you need to know to run your business correctly and not, get in trouble or run afoul of the law. But more importantly, they teach you how do you get customers, how do you build product that customers are going to love, that they're going to pay you for, how do you get that traction, and how do you do the things that actually build you into a real business that can grow to the point of being in the Russell 2000 or any, hopefully the S&P 500 or the Dow even one day, right, if all things lay out correctly there. And there's a lot of wonderful accelerators across the country that each have their own flavors, and so that ability for them to give you that initial start, that introduction to a lot of other investors and mentors was critical for our success. And then the other program that you had mentioned is, from my experience with all of these different Midwestern states, I truly think that Nebraska leads the way in terms of the economic development programming that we have. We have 2 unique programs that don't have an equivalent in any other state. The first is the prototype grant from the Department of Economic Development, where it's a 2-to-1 match that's non-equity dilutive to go out and build your product. So if we have $50,000 and the state likes our concept, they could give us up to $100,000 as a grant that we, of course, need to prove that we're spending it on people in Nebraska, spending it on the correct activities, but is a great way to stretch our dollar and be able to get off the ground and get started as a company, especially in the Midwest. And then the other one is Invest Nebraska, which is a state-funded venture capital fund that's able to match on a 1-to-1 basis up to $500,000 over the life cycle of a company. But that one's incredible because, one, it kind of lets you start the round out early. I'm sure talk a lot about like soft commits or the art of how you actually get a venture deal put together. And so it's huge that if you have a good relationship with Invest Nebraska, you could start with $150,000 or $250,000 before you even go to market to the other investors. You still need those investors because they can only match on what you get from the public market, but it allows you to get that head start. And then that second part, though, really helps build out the program and I would say thread the needle between having safety rails and making sure that it's being invested into real companies and it's not just the state funding something to fund it, while still giving flexibility and the insight to the people that are running the Invest Nebraska firm, where they're able to take risky bets. It doesn't have to go through the state legislature committee to say, should we invest in Vesta or not? And it allows them to act very flexibly and act very quickly to actually adapt on the fly and help grow many, many successful companies. I mean, there's been quite a few winners. One that Invest Nebraska invested in, one that's raised over $20 million from the Valley, and then a couple others that have 100, if not 200 employees, and probably wouldn't be here today without that initial seed capital from Invest Nebraska.
Thank you. And those are all great points because a lot of us here at the SEC, we talk about, investments from investors, right? And we're focused on kind of that area of capital formation, but it matters so much on what else is in the ecosystem and how a company can get that backing and support to be able to grow and scale to a larger stage. So appreciate you sharing that. I think looking at that, the investor capital, And one thing we've heard from you and we've heard from a lot of other entrepreneurs is the difference between the investor pool in the Midwest and different areas even within the Midwest and how that differs from your traditional capital raising hubs. And as part of this, I know you have you have experience with it, and you also have policy suggestions. And since we are talking about recommendations later today, I would love for you to talk about kind of what you're seeing and experiencing and kind of where you think the SEC and the Commission should be looking at to change the rules going forward.
Yeah, happy to talk about that. So growing up in Omaha and raising capital, right, there was a lot of great remarks from the commissioners on the accredited investor standard, why it could be lowered, why it could be raised. Very much from our experience, I think that changes need to be made to give more access to capital and bring more investors into market. I think there's a lot of different arguments that can be made that from a fairness perspective of an accountant or a lawyer or a manager, mid-executive, at a Fortune 500 company in Omaha might be making $120,000, $130,000. They're not able to invest as an accredited investor. But if that same person moved to New York or to San Francisco, they'd be making $225,000 or $250,000, and now all of a sudden they'd be able to make that investment. And so there's some tyranny of where you're born dictating your destiny there that I think is just fundamentally not fair. And it's cost some of my colleagues capital of someone that's a big believer in what we're doing, wants to write us a $15,000 or $20,000 check as a part of a Reg D round, and we can't because they're not meeting that accredited investor standard. We've had to turn them away. And so I think there's truly anything that lowers the standard would be an improvement versus where we're at. But I think tactically there's really two routes that make the most sense to me. One, some type of cost of living adjustment, whether it's on a state-by-state basis or some other type of regional basis that accounts for what it means to actually live in Nebraska and what $115,000 or $120,000 can do for you versus in New York or San Francisco. Or number two, to what the acting chairman had talked about of having some type of percentile test based on your income where you can invest up to that amount. If you're matching the IRS income brackets would be a good method to do that. And as long as that second method is a self-certification where, if Jennifer was like, I believe in Vesta, I want to be an investor, and, I make up to this income line, so I'm able to invest $7,000, and she just has a simple one-sheeter, kind of like we do with an 83B or something that's very simple for us to keep on file as a company, to say that she met that regulation, hadn't gone over that number with other private investments, and then she's able to invest into our company. That would bring so much latent capital off the sidelines, especially in Midwestern states like Nebraska, that we would see a sea change in terms of the new starts and in terms of that ecosystem really rebalancing, where right now we have a negative reinforcing cycle of you don't have the capital, so you can't build the product, so you can't get traction, so you can't get more capital. If we can get more of that initial capital, especially for that critical friends and family first round, then I think you're going to see a wave of innovation coming from the Midwest.
Thank you for sharing that. And I hope everyone remembers to vote at the end of the day. More instructions, so hold off on voting for now. Voting will be open about 4:30. There are recommendations. You can see what they are. If you would like to weigh in, please do so by 3:30. Just wanted to give that plug there. And before I close us out, can you share the best piece of entrepreneurial advice that you've received?
Ooh, that's a great question. Real quick before getting to that, though, I did want to mention, that impact of, I know we're all here, talk about this and many others, but especially for Congress, right? The impact of the changes, the impact of the programs. Like, I would not be sitting here today as the CEO of my company without the Opportunity Zone program. We got started in 2019, but the only reason we made it through the pandemic was because of an Opportunity Zone investment by someone who invested into an events business in the middle of a global pandemic. I think it's pretty safe to say that the Opportunity Zone and all of the incentives there to bring that capital to bear very much accelerated that happening. And so if you can emulate that change by changing the accredited investor standard or other changes that bring more latent capital off the sidelines, it's going to result in more Vestas and hopefully even companies even bigger and better than our own. And the best advice, I would say, is go faster. If you're building your product, if you've been working on it for months and months and months and haven't shown a customer, then you've gone too far. If you're not embarrassed of that first version of your product, if you're not getting it to market, if you're not showing a customer even the wireframes or the designs of what you're building before you've written all that code and trying to get a pre-sale or a pre-commitment, then you've waited too long. Because every time in my career with DriveSpot or with Event Vesta that we've built in private or we haven't pushed it and we haven't got in front of customers as quickly as possible, we've always regretted it. And those features were like, it's not quite ready for prime time yet. We're not sure if it's going to be loved yet. Those are the ones that actually killed it when we got it in front of the customers as soon as possible. So don't be afraid to move faster. Don't be afraid to be embarrassed of your product.
Excellent. Thank you so much for coming. And Stacy will come and introduce the next panel. Thank you.
Andrew, thank you for sharing your thoughts and highlighting the additional struggles that small businesses face when they are outside the traditional hubs. Next up is our first panel of the day, Out of the Blocks, Strategies and Trends in Early Stage Capital Raising, moderated by Julie Zellman-Davis from our Small Business Advocacy Office.
Hello. Well, as Stacy said, I'm Julie Zellman-Davis, and I'm super excited about this panel here. This is our early stage panel. Everyone crosses, no one fits neatly into any one category, but our three panels today will cover early stage and then growth stage and then public companies. So I'm super excited to have everyone here, and I'd like to just kick it off with maybe introductions. I'll let Clay, do you want to kick us
Sure.
off?
Happy to
Just
do
a little
that.
bit who you are and a little bit about what you do.
I'm Clay Rankin. I'm founder and managing director of an early stage focused angel group in Cleveland, Ohio called North Coast Ventures. We are about 19 years old, focused on software as a service, business to business kinds of companies. And we have 7 funds in place representing nearly $90 million of assets under management. I think we may be the largest single chapter angel group in the country with over 500 investors. And I'm also involved with the Angel Capital Association, the national association that represents angel investors. I chair their public policy committee and their governance committee. And the ACA really is the country's largest representative of angel groups. In the country, nearly 200 angel groups representing probably 15,000 individual investors focused on really angel development, helping our angel investors become smarter, better educated investors.
All right. Well, hi, it's great to be here. I'm Nicole Washington. I have lived all across the United States, so I probably have an opinion about the Midwest and about the West Coast. And I've been an angel investor since 2009. And I know what you're all thinking. I started when I was 10, and yes, I did. And I actually, when I started investing in the Midwest, we were the largest, or one of the largest funds. And so that tells you how things change. My fund was investing in health tech and also kind of soft tech, so a lot of software as well. And then when I moved to the DC area, I started investing with Thai DC. Some of you may know of that, of Thai, the Thai organization. This was the DC chapter. I've also started a couple of companies. So my background is an engineer, so I tend to find problems to solve. So one company was a tech company, the other was a gluten-free food manufacturing company. And I think I've been involved in ecosystem development, so some of my perspective will come from that. I heard Andrew talking earlier about the capital and the Midwest versus the capital on the West Coast or the East Coast, Northeast corridor. And I will say when I started investing in Ohio, we would, as a fund, invest $250,000. And when I moved to California, my friend would invest $250,000. So the money flows differently in different places. But what I found is the companies still have issues in growing and scaling. So that's one of the things I've been working on for a long time now. Happy to be here.
Great. Well, thank you, everyone. My name is Brian Belay, and I am during my day job, part of KingsCrowd. So I'm the head of product, the vice president of product there. And what KingsCrowd is we are building tools for founders and investors who are investing in the investment crowdfunding industry. That's regulation crowdfunding, Regulation A. And we provide data and analytics so that both those investors and the founders are able to make more data-driven decisions. So we've collected more than 300 data points on every single company, daily funding data, deal terms, and everything else related to that. On a personal note, I have invested in more than 250 startup small businesses myself through regulation crowdfunding, Regulation A, as well as a little bit of Reg D. And then I also serve on the board of the Crowdfunding Professional Association. So we are very focused on the regulated investment crowdfunding industry and hoping to get a chance today to talk about some of the good things that are working, as well as some of the improvements that I think we can still make there.
And I'm Keith Zittel. I'm an attorney at Michael Best & Friedrich. I'm a predominantly startup company work. I also represent a number of investor funds. I think we were the number 2, did the second most deals in Colorado, the Rocky Mountain, Midwest regions, and I believe in Texas as well. So we do a couple hundred venture financings every year. I also work in from beginning formation for companies from very early idea stage and introductions into investment funds and growth, and a little bit of exit work as well.
Great. Well, I'm excited to have you all here. I think this is going to be great. And I want to start us off by just exploring some of the trends that you all are seeing from your various geographies and perspectives in how early stage businesses are accessing capital. So Clay, do you want to start off by I also want to just quickly put in a plug. I know today there's going to be lots of terminology used, and some of you are familiar with all the terms and probably in depth about them, and others, there may be terms that you're not familiar with. So our office has put on SEC.gov a glossary where you can look up things, everything from angel investor to, a small emerging growth company, and all the things in between. And so check it out. You can go there on SEC.gov. There's in the menu, if you're on your phone, there's a tab for a small business. And if you're looking for a term and it's not there, let us know, because everything that is there is something that we've had folks tell us, it'd be really helpful to know more about this. And you can email us at any time, us being our Small Business Advocacy Office at smallbusiness@sec.gov. So with that infomercial out of the way, Clay, do you want to start off by just telling a little bit about what angel investing is and how they help small companies, and then what you're seeing in your area right now?
We're probably speaking to the choir here on what angel investing is, but we're primarily focused on that gap in the marketplace between friends and family funding and institutional venture capital funding, focused on companies that are really proving their business model and just getting traction in the marketplace. I think that's the primary focus right now. Frankly, in the Midwest, and we'll talk a little bit about geographical differences, I'm sure, we don't see much crowdfunding in our arena. And so I'm curious to get a little perspective on how we see the issues and challenges for crowdfunding going forward. Just looking at the market generally in the Midwest, I think we saw I think after COVID passed, we saw a pickup in activity, and then I think we've been seeing some trailing off. And I can tell you in the last 6 months or so, we've seen some real challenges in fundraising for early stage investing. I think that one of the comments that I've seen from a number of our investors is that they typically allocate a portion of their portfolio to high-risk investments. And with the volatility of the stock market, particularly as we've seen some trending down recently, there's been a real concern about allocating more resources to that high-risk segment. And so that's one factor. I think another factor, which was alluded to earlier by one of the commissioners, I think that we have also seen a dearth of exits. And so it hurts the early stage investor because the institutional investors that come after us are not seeing their exits. They're not putting as much capital to work, so that as we're trying to build in our sector, it's getting harder for us to move our companies to the next stage of funding. So I think that's been of real concern to us, and not sure how we're going to overcome that at the moment. We can get into accredited investor definition stuff a little later too, because I think there's a factor to talk about there.
Excellent, and definitely want to get into that in a little bit. Nicole, obviously you're also an angel investor, as you said. I believe, and you can tell us a little more later, that is through this angel investing that you've developed these contacts now, and you're working in areas of importance to national security, and you wear many hats, I guess is how I'll sum it up. But would love to talk a little bit about the companies that you've mentioned that you've founded 2 companies. Tell us a little bit about them, and how did you fund those companies?
Yeah, no, that's a great question. As Clay was talking and talking about angel investing, and you mentioned institutional investing and VC, one of the things that I found is VC, venture capital, has become like the sexy terminology, right, for starting a company. And sometimes people don't even realize that angels often come before VCs. And when you look at the large tech companies that are out there today, almost all of them started with angel funding. And I like to say angel is when I invest my money into your company. VC is when I invest someone else's money into your company. So you can judge which one is harder. But my companies were all self-funded, actually. And I think the reason why I mentioned VC is sexy is because just because you start a company, it doesn't mean that you have to raise money for it. What my company was self-funded before I became an angel investor, so it doesn't necessarily mean I had a whole bunch of money to fund it, but there are all sorts of other strategies that you can use. When you think about the types of companies angels invest in, you can think about, is your company that type of company? Normally, we're all looking to make a return on our investment, right? So we need you to work fast, as Andrew was saying, and you need to be able to generate capital fast to pay it back, right? To pay us some sort of return. So if your company is not a fast growth company, it's probably, you might want to look in other places. But there are some other guidelines that you can look at to determine, should I raise money? How much money should I raise? And then there's all sorts of people in the community that can help with that as well. You're going to hear some things about crowdfunding, which I think would be great for that too. But when we think about raising capital, and because the commissioners are listening, I hope, I would say we should try to have the mindset of widening the aperture of who can invest money. Because the investor is different no matter how much money they make, right? If you think about household incomes and what people have, it doesn't necessarily mean that they're good at investing their money. I'll save the rest.
Fair enough. Well, I'll just to second what you said, our office puts out an annual report every year, and in the last annual report, and we include a lot of data about what's happening with capital formation in businesses across the spectrum. And only 2% of small businesses raised equity from investors. So to your point that it's not for everyone. It's a very important slice of the pie, but it is a small slice of the overall types of funding. So with that, Brian, since we're talking data, I would love to hear your thoughts, or just maybe more what you're seeing about how companies are raising capital.
Absolutely. So on the investment crowdfunding side, we take a look at the daily data at King's Crowd. I actually pulled it up this morning just to see. And zooming out, it's really impressive. So Reg CF, since 2016, there have been more than 8,700 offerings. Compare that with some of the opening remarks, right, where IPOs have been on the decline. And this is just a great opportunity to get more of those average American investors to be able to have access to some of these opportunities. Now, some of the other interesting trends along that lines are that the way I think of it is there's kind of 2 different companies that utilize investment crowdfunding. And again, it's a tool, right? Venture capital is going to be the right tool in a lot of situations. But when you take a look at crowdfunding, there are those companies that are trying to be the next unicorn, venture-backed, IPO-type companies, those high-growth companies, and they're absolutely using crowdfunding. We've seen multiple companies over the past few years raise their max under regulation crowdfunding and even max out under Regulation A, which allows them to go up to $75 million. But the other side of it is allowing some of these smaller businesses, these businesses that perhaps don't appeal as much to venture capital or traditional angel, and they are also being able to raise capital. And so we see a lot of that in the market as well. Now, in terms of the types of financings and some of the interesting things, because the types of businesses vary that use crowdfunding, we see that typically over the past few years, it's been a breakdown of around 90% of these offerings are being done under equity, and about 10% are being done via debt and revenue-based financing. So that's an interesting model where instead of just having a fixed interest rate, the amount that the issuer pays back to the investors actually varies depending on how their revenues may fluctuate, for example, throughout a year. So these are a lot of the different trends that we're seeing in terms of regulation investment crowdfunding and also across Regulation A. But it's just in terms of the amount of capital raised, right? This has been around for only 8 years at this point in time. This is something, right, that was introduced in May of 2016 for Reg CF. There's now been more than $2.2 billion raised for more than 2 million Americans, and it really is opening up the aperture, to use some of your vernacular, to allow more people to be able to participate. So when we talk about accredited versus unaccredited investors, both of these people, regardless of their backgrounds, are able to invest in these businesses.
Well, that's great. Keith, I'd like to turn to the lawyer in the room. And I'm a lawyer, so I will not make a lawyer joke. But I do think it's really helpful to have someone who sees deals across a broad spectrum of sizes and shapes. So would love to hear kind of what funding opportunities you're seeing in Colorado.
Yeah, thanks for not making a lawyer joke. It hurt my feelings. We see everything from very early stage friends and family round through, roughly around 50 million Series B, Series C, some larger than that. So we see a lot of that early stage, pre-seed, seed. Series A is where I live a lot. And I think the Midwest is sort of a great example of where there still is a fair amount of money flowing to good companies, good founders, good ideas that are solving and tackling problems that have an industry there. So while we've seen a downtick since 2020, 2021, which is understandable, I think that the money is still flowing for great companies. I think a lot of funds you're seeing a lot of follow-on rounds. So funds that are already invested in companies, you're seeing them reserve more of their funds for portfolio company bridge rounds, things like that, to get them to a larger round. To what Clay was talking about with sort of being a bit of a logjam with exits, I'm curious to see what you see on the angel side, but we've started to see an uptick in secondaries, which normally you would think of or at least we normally think of it that as founders taking money off the table after a certain period of growth. We're seeing a fair amount of angels and early investors ask for returns in further down rounds. So we've started to see an uptick in that, which is getting, that's what LPs want to see from their funds. They want to see those funds being spit out to them. So we're starting to see a little bit of that, I think. Brian's crowdfund, we don't see that very often. We're typically in the VC-backed space, but we have that conversation with founders from a very early stage of what are your goals? Where is the company going to go? Is VC right for you? Is there sort of non-dilutive capital that we can try to get you access to? So that's a lot of those very early questions when you're starting your company are really important to be asking, whether that's your advisors, consultants, your attorney. So I think that's a great position to start from. Is VC right for you? Like you said, it is a small portion of small business companies, but it is definitely it gets the attention, it gets the headlines. It is the sexy thing to talk about for startup companies, but I don't think it's right for everyone.
No, I appreciate that very much, and that's actually perfect. You queued this up perfectly because during registration, we asked folks, what would you like to hear about at the Small Business Forum? And we got a lot of folks who said, look, I don't have access to VC. I don't have a wealthy network of friends and family who can fund my business. So, we'd love to hear, they asked for suggestions. And I know, a lot of you deal with folks who do have access to high net worth angels or, can pay for your law firm. But would love to, hear if you have thoughts on what folks like who are in that situation, approaches they may try. And also I think it's all related, and you've started talking about these things already, but I think in connection with that, obviously reg crowdfunding is going to be an option for some of those folks who may not have access to other funding opportunities. But also would love to go ahead and start talking about the accredited investor definition and how that may impact even whether you have access to wealthy friends and family or not, the accredited investor definition. And then also another topic that came up a number of times in registration questions, and you'll see it as one of not our recommendations, the participants' recommendations, is a question about finders. And this is that idea where if you have companies who need investors, and you have investors who are looking to make investments, someone who might, serve to make those introductions, but is not a registered broker-dealer. We get a lot of, questions about wanting clarity in that space. So anyway, that was a whole lot of different topics that I'm going to throw out to the panel, but in my mind, they're all related. Hopefully, you see those connections as well.
Julia, I just wanted to ask Brian, if I could for a minute, to maybe explain what types of companies do you typically see going after crowdfunding? Because from our point of view, if they're a high growth opportunity, they should probably have pretty good access to the angel community. So it feels as though there's something different going on in the types of companies that you're looking at.
I would love to address that, because something we hear all the time from, not pointing fingers at any VCs, definitely not in this room, but it's that companies that crowdfund are perhaps second rate, that they couldn't attract traditional venture capital or angel, that it's negative signaling, that it could lead to issues with follow-on investments from venture capital because of messy cap table impressions. These are a lot of the objections that we hear all the time. And I think in the early days, it was still very untested, right? This just started in 2016. People didn't know the types of companies that were going to use it and whether those companies would be able to be successful to be able to attract capital. So to go back to your question, Clay, we do see kind of the two types of issuers. There's definitely a cohort of those companies that are high growth. And some of those companies, for example, raised a Series A or a Series B, and they want to give 1 million of that to their customers. They want to involve their customers to be able to give them. Those are the ones, honestly, that sell out very fast. Because if you have a passionate, engaged user base, if you're of a strong community, a good audience, those types of things are very good for raising that type of capital. Now, on the small business side, right, we have a lot of mom and pop shops as well who they have patrons that come in and want to be part of the mug club and invest $100 to say that, I'm now a proud owner in this company, this small business, whether that's locally or just something else they support. And what that actually does, there's been studies from some of the broker-dealers, I think, that did a study about this. By turning your customers into your investors, they're actually boosting the LTV, the lifetime value of that customer, where economically it actually makes sense to get a small investment, even if you're not going to be a large venture backable IPO type company, to be able to turn that person into an investor. They're going to tell their friends, they're going to bring more people, right? Kind of that approach. So we definitely see a good mix. I don't know if that's...
Well, part of the reason why I asked the question, you surprised me actually when you said about 90% of the money goes to equity.
Equity deals.
And presumably anybody who's putting equity into a company expects to have a return. Mm-hmm. And how do you create a return in a company that's kind of the lifestyle company?
That's another great question. So another thing that these companies can do is when they're doing their offerings, some of them offer perks. So again, I mentioned kind of a mug club as a little joke, but there are companies that when you do that offering are able to get other non-monetary value to give back to your customer in addition to some of that. Now on the investor side, to your point, how do you get a return on some of these companies? And we've seen a lot of acquisitions and a lot of, there's actually been a number of IPOs. I think there's been upwards of 20 IPOs now.
Really?
The prices, again, it's a volatile market out there right now, but it's, I think, a great question in an area where it does need to mature some more. It's still very young. And I think the verdict is still out there in a lot of people's minds in terms of, am I going to get a return on this dollar when I invest?
Yeah, you also have to, right, think about how much return you want, right? We know what we want, and it may not be the same for someone investing in crowdfunding, right? When you think about your investor, if you're going to raise money, you have to think about what is that investor's motivation. In the field that I'm in most recently now, in intelligence or defense, there's a mission behind that. So sometimes the early stage investors may not require the 20% or whatever the return they're looking for because they have another return in mind on the back end. So that's also very important too. And when I think about ecosystem building, and I think about you don't have the family and friends network, you may not have that network, but you need a network, right? So you do need to have people around you who can show you different avenues or who can make introductions for you. And you don't always, generally you don't want to have to pay for that because you want your money to be going to something that's building equity for you. I'm not making a judgment on the dealer broker because I think there's a time and a place for that, but be careful early on, that might not be the time and the place. So Clay, did you want to talk about the accredited investor expansion or contraction?
Yeah, you want to go there now?
Yeah, no, that would be great. I want to make sure we have time to get to audience Q&A at the end, so I was actually just going to say, to the extent you have recommendations of ways to improve any of these things, start adding those in.
Well, I think that from my perspective, it may not fit with all of the commissioners' perspectives on this, but I think as a starting point, we sit in the Midwest. And as I think Andrew pointed out earlier, the whole income disparity between what we see in the Midwest and what we see on the coast is huge. And I don't see that addressed in the current definitions. And I think that's fundamentally wrong because there are so many highly capable, skilled individuals who don't happen to have the income or net worth that ought to be able to participate and create some wealth. And I think as the Angel Capital Association has advocated for some time, I certainly feel strongly about this. There ought to be an educational component that focuses on building sophistication and allowing people who don't have the income or net worth to participate. And in some respects, in 2020, I think the Commission recognized this when they started to allow individuals that have passed the Series 7 and 60 or 65 and 82 exams. By definition, those are people who have developed sophistication, and they may not have the financial wherewithal that would otherwise have allowed them to participate, but they can. So why not focus on building sophistication through education? Here at the Angel Capital Association, we've spent 20 years building an education program that really distills the insights from some of the most successful angel investors in the country. Let's find a way to leverage that. It may not all come from the Angel Capital Association's program, but I think it does reflect an avenue that I think we could pursue. On the other hand, in 1982, when the definition or the thresholds were set, they were pretty arbitrary, to the best of my knowledge. Mm-hmm. And so what makes them any more applicable today than they were before? So that's another perspective. And then the third one is I fundamentally don't believe that wealth or income necessarily correlate with sophistication. All you need to do is look at the results of Theranos and you understand that you can have very wealthy people who put a lot of money in, but they didn't follow the kind of procedures that we try to advocate as angel investors through our educational programs at the ACA. So I think that well, there you go. So I hope that we will give this some further consideration because I think that this could open up a lot more capital for entrepreneurs who are focused on this early stage sector.
Go ahead.
Okay, real quick, just to echo off one of the things Clay said, why aren't there more of these businesses? Why can't we get more of these investors the opportunity to invest in some of these businesses? So 2 changes that we have definitely taken a look at in terms of regulation crowdfunding that would help enable that. So on the low end of regulation crowdfunding, on the small business side, the disclosure requirements, requiring GAAP financials, some of these things are very hard, where the median issuer last year in 2024 for Reg CF raised less than $100,000. It was basically 114. So 50% of all Reg CF deals just need $50K to $100,000. If you take a chunk of that and 10,000 or 20,000 is going to your legal, getting your GAAP financials in place and everything else, that's a huge portion for such a small amount that otherwise would have been going to the business. So we absolutely support being able to make some of those onerous requirements a little bit easier for the smaller businesses that perhaps are only looking to raise, say, up to 250, 350,000. On the other side of things, we saw a huge influx in terms of higher quality companies when the Reg CF cap was increased from the 1.07 to the 5 million. That brought in new issuers to the space that previously wrote off 1 million as too small of an amount to be worth their time. We actually support raising that cap to even 10 or 20 million, where we think there's still a huge gap in opportunity there, where more of these even venture-backable companies would be open to Reg CF as an opportunity to raise perhaps seed, Series A, and perhaps later growth rounds using Reg CF, which would bring more opportunities to the average Americans and also more diverse funding opportunities for the founders.
Great. In just a minute, we're going to open it up to audience Q&A for these folks. But Nicole and Keith, did you have anything you wanted to add on?
Well, I was just going to, both of you have great points. Clay, you made a good point about look at the origin. I like to think about solving hard problems very holistically. Like, this is a complex issue. There are many factors to consider. It's almost a systems thinking problem, right? You have to think about it from many different angles. And something you said, the origin of the original accredited, it's changed a couple times, but the original accredited investor definition is very important to consider as we think about, how to expand it or contract it or whatever, how to change it from there. So.
I'm just going to say it's nice to have a lawyer, but it's also good to have someone who thinks like an engineer. So thank you.
Julie, I wonder if I could add one other thing too, because the Commission is obviously very concerned about investor protection. And I understand that, and I think that there is a sense when we've talked to folks here in Washington, is that there is this sense of pervasive fraud that has to be addressed and protect investors. And I must say, in our industry, in the angel industry, we don't see that. And I can just say from personal experience, we have had one investment that was a fraudulent situation. The Ohio Attorney General went after them, put them in jail. It was appropriate. We lost $250,000. And that's out of the $90 million or so that we've got. That is just very tiny. It is not significant. I do think some people get a little bit concerned and confused about our industry, where we believe that about 50 to 60% of the companies we invest in will go belly up. That is not a function of fraud. That is a function of the challenge, the difficulty that entrepreneurs face in trying to get a business launched. So just want to make sure that we differentiate the sense of what fraud really is and where it's being seen so that it's addressed in a targeted way.
I was just going to say the exact same thing. I think I have seen 2 companies that have perpetrated fraud, and both were caught relatively early in their life cycle. But companies on a regular basis wind down and liquidate, and because there's for any number of reasons, right? So it's a difference of high risk investing because of the nature of the company versus fraud.
Well, this has been a great discussion. Now's the time for the audience to participate. So while people think about venturing to the mic, I'm going to ask the first question. And I think I'm going to put it to Nicole and Keith. So we received a lot of questions during registration, including from Corey, Desiree, and others, asking for tips on how entrepreneurs, especially first-time entrepreneurs, can find capital funding resources, investors, and networks. And Nicole, you were talking a little bit about it, and then Keith, I think your perspective from being an attorney in the Midwest. Whoever wants to go first, Nicole.
I would say accelerators is a key word. Usually your local community has these incubators, accelerators. I'm very much a friend of federal government. They have great programs, SBA. You can look, go to those websites, connect with people like us. We're usually very friendly to connect. The Angel Capital Association has a list of investor groups on their website. And so what Clay was saying about how you don't see a lot of fraud, a lot of that is because it's a network. It's kind of a tight network, which is some of the issues, right? But you know each other, and you're doing a lot of due diligence. So you're looking very, the fine line, like what is this company's management about? Who are these people? You're really looking into the company, but with that.
No, I completely agree. Accelerators, incubators, we work with, depending on your state, your Office of Economic Development within the state. Colorado has a great program. I heard Andrew talking about Nebraska's. Colorado's is very similar, have state grants, work with federal grants. We work with Colorado startups in Colorado, Western Slope Startup Week, Denver Startup Week, Boulder Startup Week. There are any number of events going on at any time, and the more that you can surround yourself in a similar ecosystem and similar community of people that are also startup founders, are around angels, are around VCs, your network will just expand. The more you do it, and I think more and more states are doing that. It was very, it was Silicon Valley and New York City, Washington D.C., and now you're seeing it explode. Austin, Texas, Denver, a lot of university-based communities also have great programs that you can get in with.
Sir.
Thank you all for.
We have to flip it on. I'm not sure. Also, we can hear you if you can't.
I'm also an engineer, so I feel a little bit bad about that one. But thank you all for the time today. This is awesome. I'm from Cleveland, so now I'm familiar with North Coast Ventures. Todd Fetterman, he's actually one of the folks who helped. I'm a founder in a blockchain. So my question is two-part. One, what are some of the conversations that still need to be had from a regulation standpoint when it comes to investing using blockchain technologies to keep it really straightforward? I think the SEC has been fairly bipartisan on the issue of blockchain, but I think there's a lot of education that needs to be had, right? So how do we continue to educate not just regulators, but general consumers? And then obviously being in blockchain as a founder, how do you start to break through with the cutting edge or high risk technologies where a lot of it's not just building the technology, but educating people on what you're talking about and why it's, a real technology, right?
Well, I'll start off and then I'll kick it quickly to the panel, but you are like a walking promo for our ongoing roundtable series. There's one here tomorrow in this very auditorium on crypto and other issues. So just thank you for that plug with that you may not have realized.
No
But
problem.
to the extent anyone else has something they want to say here.
I would say, start with yourself and the knowledge that you have in educating people. I would go directly to Todd and Clay and, ask if they want you to come in and just talk to the angels about blockchain, the technology, what it can do. Maybe, use some, from an engineering perspective, we always like to use the black and white and the, the technical terms, but we got to get outside of that, right? Maybe talk to a liberal arts English major or someone else who can help you translate that into something that's more digestible. And a lot of people are doing that now with quantum because it's another one of those emerging tech that who knows, right? Nobody really understands it. But that's what I would say right off.
Sir.
Yes, thank you. My name is Thomas Lopez Pierre. I'm the fund manager for the Urban Real Estate Fund, LLC, out of New York City. We're a social impact private equity real estate fund. We raise capital exclusively from Black accredited investors, and we invest exclusively with Black real estate entrepreneurs from DC to Massachusetts to build affordable housing in the community. So I wasn't going to say anything, but Clay set me off. And I just wanted to say, I agree 100%. If you take what he said and you impose black people, that is the situation. In the black community, you find that the incomes are, the less people that earn multi-six-figure salaries. And when they invest, they don't invest in the black community. They invest with wherever their white peers invest. And so what happens is people think that there's an economic benefit to black people, what we call the talented 10th in the black community. There's very little benefit. If they were to die tomorrow, there would be no impact in the black community because they don't invest in our communities. They invest in tech, they invest in the sexy stuff, but they don't invest in the small businesses that are in the black community. And so what desperately needs is something where we can encourage the black professionals that live in the community, something like if we had an empowerment zone where if you live in this district, you can invest, $10,000 if your income is under $10,000, $100,000 a year. Where instead of, I guess the point is where it's community-based, where people in the community can invest in the geographic area of their community. That would be really, really helpful in terms of creating more wealth, because the limits are not really helping us. I raise all my money from black folks, and I have to convince them that they're investing in their own communities. Everybody else invests in black communities is getting wealthy. So it would be easier if I could get bus drivers, school teachers, and social workers that live in the community to invest in real estate in the community, because the lawyers, doctors, and investment bankers, that are black, they don't live in black neighborhoods. They don't live in black neighborhoods that are where low-income affordable housing is. So if you guys could suggest a way where the lower middle class that live in black neighborhoods could invest in their communities, if they could get some kind of special exemption, that would be really, really, I think, really helpful. Thank you.
Could I make a few comments on that? So one of the first things that comes to mind, obviously, regulation crowdfunding, depending on the use of the proceeds, how you're looking to raise it. Now, one of the things you can't do under regulation crowdfunding today that's prohibited is raising it for a fund, right? You can't raise a fund under Reg CF, nonprofits, community investment funds, things like that. So another thing we actually support as a suggestion to the commission is allowing some of those funds to be able to raise capital under Reg CF, which would open up more opportunities for the bus drivers, for some of those other people, non-accredited investors, to also be able to invest.
Yeah. No, and actually, I do know some of the, what we would call talented 10th that do invest in those things, in those communities. So I wouldn't want to generalize either way, but I feel your pain. I feel your pain. And I'd be happy to connect you with some of those folks as well. Yeah.
Great. So I think this panel is wrapping up for the day. It's been a great panel. Sorry for those who had questions and we didn't get to them. So thank you for sharing your insights on small business capital raising. And now I have the privilege of interviewing Jasmine Jones as part of our next one-on-one conversation, Going the Distance from Idea to Execution. Jasmine, it's great to see you again. Thanks for being here.
Thank you for having me.
We talk about early stage founders frequently, and I got to watch the documentary featuring you and other founders, and I recall that in some ways you started your journey really early on, like maybe about 9 years old. So if you could introduce yourself to the audience and share a little bit about your entrepreneurial journey.
Yes. Hi, everyone. My name is Jasmine Jones. I'm the founder and CEO of Maya. I did start this business when I was 9 years old because we offer for breast cancer survivors completely customizable and fully insurance billable breast prosthetics with a state-of-the-art fit experience, both in person and online. And I was inspired to create this after watching my grandmother, when I was 9 years old, walk into a medical supply store. And I remember she was shopping for bras, but to get to these bras, she had to walk by aisles of bedpans, adult diapers, laxatives, and in the back corner, they had a curtain And that's where she was supposed to go in and try on her post-mastectomy bras after her breast cancer diagnosis. And I recognized in that moment that that's where a lot of survivors were going. And I knew that someone had to do something about that. It felt very weird that my sister, my mom were shopping in department stores. But my grandmother, just because she was living with this diagnosis, this cancer that had impacted her life, that she was now subjugated to this back corner. And fast forward, many years later, I was crowned Miss District of Columbia, USA. And my makeup artist was diagnosed with breast cancer. And she asked if I could join her at a breast cancer 5K. And I said, sure, absolutely. I'll wear crown and sash. And when I walked there, the first person I met was a breast surgeon in Washington, D.C. And we start walking and talking, and she tells me about how her patients 20 years later, was still shopping inside of medical supply stores for post-mastectomy bras and prosthesis. And in that moment, it was just very full circle. I'd had a background in real estate development and luxury retail. And I told her, I said, well, if it were my business, I'd make it a lingerie store. And it'd be absolutely beautiful and pink and lace on the walls. And we would have the customer service experience that I learned from Nordstrom. And, we'd have these diverse suppliers, and we would source these beautiful things from all over the world. And at the end of the walk, I said, well, good luck with that business. Because I kind of gave her a playbook. I said, well, good luck with that. I hope, you do a great job with your patients. And she said, whoa. Can we maybe talk again and maybe start something together? So very long story short, that's what we did. Right outside of Washington, D.C., we had a brick and mortar store, Cherry Blossom Intimates. It's a fully accredited medical facility, but it looked like and felt like a lingerie boutique. Pink lace, but a fully accredited medical facility so that we could help breast cancer survivors and those who had not been diagnosed to shop in the same place and both have dignity. And then the pandemic happened. And we had to figure out what would we do if we could never see a breast cancer survivor in person again. And I don't know if you guys remember this, but we were like wiping down our groceries and scared to open the doors. And our survivors were still facing the same need. So I created a telehealth portal where we could fit these survivors from the comfort of home. They could still receive their same post-mastectomy bras and breast forms, and we would deliver it to them. And I joked that it was the Warby Parker of boobs. But we really did sort of take their model and make it better for breast cancer survivors and implement it that way. During the pandemic, I went through the TechStars Accelerator program. Fortunately, because of the pandemic, I was accepted into Kansas City's, and I was able to take it remotely, so I did it virtually. And within 30 days of leaving TechStars, I'd closed $1 million in venture capital. And that was the impetus for our growth. We've served over 21,000 patients at this point, keeping in mind that these products are fully insurance billable. And we accept most major health insurance plans, including Medicare, Medicaid, and then most of the major private insurance providers. I've raised a little over $2.25 million. Forbes Under 30 list maker, Washington Business Journal Under 40 list maker, a whole bunch of awards and stuff. A U.S. Chamber of Commerce Top 100 Business for Digital Innovation. So we've had a lot of accolades. But I guess we'll get to this soon, as how funding has come to us in a lot of different ways. So we can talk about that.
Great. Well, I want to say, what a phenomenal story that you have, and sort of the necessity as the grandmother of innovation, so to speak. So you found you had to shift your business, hone your business model. You found a lot of resources as circumstances changed and challenges. So over the past year, we've talked to a lot of entrepreneurial support organizations. You've worked with quite a number of them. You've had funding from investors as well that have brought more to the table than just the check they wrote. So maybe share a little bit with the audience about how entrepreneurial support organizations and early stage investors fit into your company's life cycle. And can you give some insight into the support these players played along your journey?
Oh, yes. I'm probably the biggest champion of these ESOs, mainly because I walked into my business knowing I had a vision and I had a dream, but I didn't know what a pitch deck was. I happened to run into a venture capitalist at a lunch, and she said, well, what do you do? And I told her, and she said, well, can you send me your deck? And I had to Google what a deck was. But I sent it to her, and I closed it, right? But I didn't know. And so many business owners have a great idea. They have a great mission, a great vision. They have customers. I studied business in college, but we didn't really get that deep. We didn't get to, is this an accessible option for you? And I think maybe partly it was the times, it didn't really exist in a amplified way. It wasn't hot or sexy, like someone said earlier, but now it is. So I think that messaging is really important. But these accelerators have really guided me in my business. I locked in during Techstars. It's a 13-week program. I ordered the groceries to my house. I made casseroles. So I didn't take any time to go out and eat, literally. I just sat and I focused on my business for 13 weeks. And I think that's the reason we were successful. But I went from 0 to 100 because of an ESO program. So I think it's really important that these programs are being funded so that they can continue to open doors for entrepreneurs like me.
Great, thank you. So I know one of the things that you did is you did a crowdfund through WeFunder, and we heard on the prior panel a little bit about crowdfunding. Can you speak about your experience doing that a little bit?
I will, and I'll be candid with that experience. I too heard that stigma of crowdfunded companies maybe weren't the best of companies. Maybe that's why they were seeking outside capital, because investors were turning them down. But that was maybe 5-6 years ago. Now I think it's way more commonplace. So we did raise a lot of money with venture capital, a good amount of money. But I was featured in the documentary Show Her the Money, a movie that sort of followed my journey in raising my most recent $1 million while 9 months pregnant with my daughter. And we received a lot of inbound interest from breast cancer survivors, supporters, viewers of the show who said, I would love to participate in your growth. I want to see you successful, but I'm not affiliated with an angel group. I don't have $1 million. I might not be able to pass every type of checkbox that it would take for me to write you a bigger check, but how can I do it? So we opened up the WeFunder. And just like someone else mentioned too, we offered for them not just equity, because what they're getting is such a small part of our company. We also open for them great opportunities to be involved. Like we have a tier where we'll name a bra after someone who you love, right? So we created those opportunities for people to be able to participate in the success of our business. So it wasn't just for the check size. It was also for their contribution into the success of our mission.
Great, thank you. So you've had a really interesting journey as you founded and launched your small business, had a daughter along the way as well. So what does success look like for you now, and has it evolved since you initially launched Maya?
Oh, yes, it has evolved. People used to say, what do you do for fun? And I would tell them all kinds of amazing things. Now I'm like, I like to sleep. Success has definitely evolved. For us, it was at first raise $1 million. Make $1 million, but now I want to serve 1 million breast cancer survivors. So that is my goal. And then we hit those other financial benchmarks along the way.
Okay, great, thanks. Well, one last question before we wrap up. 10 minutes goes way too quickly.
Too fast.
I know. Advice you wish you would have received?
Ooh, I would say never really give up. And even we've had times that have been so fast for our growth, so fast. Then we'd have times where we just sort of like plateau. And I didn't recognize as a first-time founder how necessary it was to have those plateau moments and not feel like your business was not successful in those moments, but recognize that there was some winning still in that, and to not give up even on those most difficult times. So I know there are a lot of small business owners that are tuning in, and that would really be my message to them.
Great. Well, thanks for being with us, Jasmine.
Thank you
I
for
wish we
having
had
me.
more time with you. What a great first half lineup. Oh, please. So I'm going to say enjoy your halftime break as you exit the auditorium. The bathrooms are to your left. There are also refreshments and snacks in the atrium. The second half tips off promptly at 2:45 p.m. Keep an eye on your countdown clock, meaning your watch, and we'll see you back here in about 15 minutes. Thanks.